Have you ever looked at an ETF's price and wondered what it's really worth? I mean, you see one price zipping around on your screen, but then there's this official value that's calculated overnight. And there's a real-time estimate that guides traders all day long. Today, we're going to decode all three of them to find out an ETF's true value. So, let's dive in.
You know how it is. If you've ever watched an ETF ticker, that price is just constantly moving up and down all day. It really makes you wonder, right? With all that noise, what is the fund actually worth? That's the exact puzzle we're going to solve today. All right, first up, let's talk about the number we all know and see. The market price. Yeah, it's that one blinking on your trading screen, the price you actually click to buy or sell. But, as you're about to find out, that number? It's really just the tip of the iceberg.
That's exactly right. Just like any other stock, an ETF's live price is in this constant tug-of-war between buyers and sellers. You get a lot of demand and the price can get pushed up. A ton of selling, it can get pulled right down. The most important thing to remember here is that this market price can sometimes drift away from the actual value of all the stuff that's inside the fund.
Okay, so to get a more stable, more grounded measure of value, we have to look under the hood at something called the net asset value, or NAV. You can think of this as the bedrock, the official foundation of an ETF's valuation.
So what is NAV? Well, think of it as the fund's official end-of-day accounting report. After the closing bell rings, the fund manager totals up the value of everything inside, every single stock, every bond, and then subtracts any fees or liabilities. What's left over gets divided by the total number of shares, and boom, that gives you the official book value for that day.
But, there's a catch. The NAV is really just a snapshot taken after the market closes. Now, it's super useful for tracking performance over the long haul, for sure, but it's completely useless for making decisions while the market is open and prices are going wild. It's kind of like trying to navigate a crazy busy highway using a map that was printed yesterday. Just doesn't work.
So how do we fix this problem? How do we get a sense of an ETF's true value while the market is actually open for business? Well, this is where a pretty brilliant little tool comes into play, the indicative net asset value, or iNAV.
The iNAV is, it's basically a live streaming version of the iNAV. Instead of making you wait until the end of the day, it's constantly crunching the numbers to give you an estimate of the fund's value based on the real-time prices of everything inside it. It's like your compass during the trading day.
And when I say real-time, I'm not kidding around. The iNAV is typically calculated and published for everyone to see about every 15 seconds. Think about that. That's an incredibly frequent update that gives traders a constant benchmark they can check against the live market price all day long.
So you can really see here how these two numbers have totally different jobs, right? NAV is the official scorekeeper. It's calculated just once a day to track long-term performance. But iNAV, that's your real-time guide for making smart decisions in the heat of the moment. They work together, but they're for completely different things.
Okay, so we've got the market price, which is always moving, and we've got the iNAV, our real-time guide to what's fair value. But what actually keeps these two numbers from drifting too far apart? The answer is this really fascinating balancing act that's happening constantly behind the scenes.
It's all thanks to something called the arbitrage mechanism. Just think of it as the market's own self-correcting system, and it's run by these huge financial institutions called authorized participants, or APs. These APs are basically the official mechanics of the ETF world, and they're constantly tuning the engine to make sure the market price stays in line with the fund's true value.
So, let's walk through a scenario. Imagine a huge wave of buying pressure pushes an ETF's market price way higher than its iNAV. When this happens, the ETF is trading at what's called a premium. So, what happens next?
This is where those APs jump into action. They see that premium, and they go directly to the ETF issuer and create brand new ETF shares at the true lower value. Then, they immediately turn around and sell those new shares on the open market at that higher price. It's classic supply and demand, right? That flood of new supply helps push the market price back down, closing that gap between price and value.
Now, let's flip that around. What if some heavy selling pressure pushes the ETF's market price below its iNAV? Now we have the opposite situation. The ETF is trading at a discount.
You guessed it. The APs see another opportunity. They swoop in and start buying up all those cheap ETF shares on the open market. Then, they take those shares back to the ETF issuer and redeem them for the underlying assets, which are actually worth more. This creates a big wave of buying demand, and that helps push the market price back up towards its fair value. So the key thing to get is this mechanism works both ways to keep things in check. Okay, so understanding how all this works is one thing, but the real power comes from knowing how to use this knowledge yourself. So, let's turn all this theory into a practical investor toolkit you can actually use.
This is the question every single investor should be asking. So what? How does this help me? By understanding the relationship between that live market price and the iNAV, you can become a much more informed trader, especially when the markets start to get a little choppy. So here are the key things to do. First, always compare the price you're about to pay with the latest iNAV. If you see a big, stubborn gap between the two, that could be a red flag. Second, in really volatile markets, the iNAV can give you some much-needed clarity on whether a big price swing is for real or if it's just temporary market chaos. And finally, remember that iNAV is powerful, but it's not the only tool in your box. You've got to use it alongside other key data, like trading volume and the bid-ask spread, to get the whole picture.
And that really brings us to our final big idea. The iNAV is an absolutely essential tool, but it's not a magic bullet. The smartest investors out there use it as a reference point. They check it against how that ETF is traded in the past, its history of premiums and discounts, and they look at how liquid it is. By putting all these pieces of the puzzle together, you're not just blindly buying an ETF. You're making a truly informed decision about the price you're willing to pay. So the real question now is, will you ever look at ETF prices the same way again?